we know that when you see an inversion between the 2 and the 10s in the past, it doesn't cause a recession, but it is an indicator that a recession could be coming in the coming months, in the coming, I guess, on average, year and a half. Mm-hmm. Are you worried about that here now, or should we be taking some of these other factors into account? For example, all the easing we've seen from central banks around the world and slowing economic growth globally.
Well, I'm certainly worried about a recession. I'm worried about a recession in 2020. I think that what makes this particular event different than inversions that we've seen in the past is that Powell has already cut once. Typically, we don't see an inversion until after the point in which the market says, oh, the Fed needs to cut, but they haven't yet. So the Fed has cut 25 basis points. They're going to go another 50 by the end of the year, and still the curve's inverting.
So you think they've been more proactive this time, despite all the criticism from the White House?
They've been more proactive, but the market is telling us today that they haven't been proactive enough, which really gets us back to what we're watching in the equity market right now, which is a sell-off that's going to increase volatility. And when we think about the Powell put, which is kind of a relationship between a spike in volatility in the equity market and tighter financial conditions, that's what I'm worried about. I'm worried the Fed's going to need to do more.
Is the case building for a 50 basis point cut or an intermeeting cut?
The case for a 50 basis point cut was pretty high before yesterday when we saw that surprisingly high core CPI print. So the Fed's got themselves in a bit of a box. It's going to be hard for them to deliver 50.
Yeah, I'm glad you just brought up that inflation data, because that also, these latest developments around this latest round of tariffs and the fact that some of those have been pushed off to December, definitely the reason you saw the market or equity market rally yesterday. But given the fact that you are seeing this inversion in this key spread within the yield curve, does that essentially force the Fed's hand here? And if it does, when you do look around the world and you see $15 trillion in negative yielding debt globally, when you see the fact that you have an inversion over in the UK between 2s and 10s curve as well, how much does that actually really do?
Well, you're a very good point. There's very little that the Fed can do at this point. The expression pushing against a string comes to mind because, frankly, the market is not convinced that the Fed can actually sustainably stoke inflation. And we had a little bit of a rally yesterday in the equity market, but then the reason we sold off overnight really had to do with Chinese data and with what's going on in Germany. Germany just had their first negative GDP print.
What about Ian, is this scary music when you already knew you were watching a horror movie? I mean, a guy like you, are you up at 6 a.m. and you see this happen, you go, oh, now I'm going to do a bunch of things different, or no?
Well, I focused on the bond market, so it's really, really fun to be in the bond market right now because yields are falling. That said, the relationship between all asset classes has started to go in a way that what ends up being bad for American stocks can also be bad for American bonds. So sometimes good news is bad and bad news is bad news is good. So I do spend a fair amount of time worrying about that.
What about people who point to refis today, mortgage purchase apps, argues maybe they're not pushing on a string? What's wrong with that argument?
It's a strong argument. However, we have seen core consumption, spending on the household level has really driven the bulk of the expansion thus far anyway. And so pushing that forward a quarter or two is good, and it might get us to the point where the trade war ceases to be an issue.
But also 18 months is a long time, right? If we look at historically what these inversions have meant, what should people actually do versus just reacting to a yield curve inversion?
Well, at this point, the damage has been done to the economy in terms of investor and business confidence. Once business confidence rolls over, we've seen that in Europe, we've seen that here as well, then companies are less willing to expand, they're less willing to hire. I'm more worried that we're going to see an inflection point in the employment market. When that happens, that's when you want to be out of risk.
So things you want to look for are a sudden spike in claims, or is it something else?
Historically, if we see the unemployment rate increase 0.3% or more on a 3-month moving average basis, that means that we're in or actively entering a recession. So I'm watching the unemployment rate.
But anything more high frequency that we can count on?
The Challenger survey that gives us layoffs, that's a good one.
Really?
Yeah.
It's that empirical?
Because it actually correlates extremely well to spikes in realized non-farm payroll losses.
What about, softer data like consumer confidence, anything like that? Do we rely on those?
Consumer confidence only matters if it rolls over into spending. So tomorrow's retail sales number is going to be huge.
We've been focused a lot on government debt, government bonds. What about the corporate side of the fixed income market? What is that telling us? Are we seeing similar yellow flags or recessionary signals there as well?
Well, credit spreads certainly have been seeing some upward pressure, which is very, very consistent with the end of a cycle. People need a little bit more compensation. However, at the end of the day, the credit market has performed remarkably well in this cycle, and spreads are probably unlikely to really gap higher unless there's a much more significant slowdown than we're expecting.
How are you factoring what's been a strong dollar into all of your analysis right now? Do you expect that continues to stay strong, or do you think that weakens? And what is that? And what is the carryover to the bond market?
Well, the most important aspect of the dollar in terms of the real economy is what it means for importing inflation or not importing inflation. The Fed is actively trying to change the way that the market perceives its relationship with inflation. And for that reason, a weaker dollar that actually brings inflation into the system would make the Fed happy. A stronger dollar only serves to tighten financial conditions, and that will get the Fed to move.
All right, so we're in a blackout window here. We're not getting any Fed commentary this week. Jackson Hole's next week. How does messaging start to sound next week?
Well, that's a great question. We've been worried about or concerned about the point at which the Fed wants to transition to price level targeting or a more average approach to inflation. We thought it might be at Jackson Hole, but right now Jackson Hole sounds like the bigger concern is going to be, can they justify going 50? Will they need to do more?
So less discussion about Dallas Fed trimmed mean kind of stuff?
Exactly. More concerned about global financial conditions and pushing against the strain.
What do you think happens to the IPO market now in this environment? I mean, we've been talking about WeWork, which is one of the more anticipated prospectuses and IPOs of 2019. We just got that out last night, and then we got a yield curve inversion in the morning. What happens to the IPO market typically when these things happen?
Well, historically, you would think that there would be a period of slowing. And then as the Fed becomes more active, valuations start to become even more attractive. So after a period of adjusting to what monetary policy is going to do, I'd expect it to pick back up.